back to the Bitcoin layer. I'm Nik Bhatia. Today, we want to explore Basel III and the Supplementary Leverage Ratio, otherwise known as SLR. We're going to understand what these two major banking constructs mean. And for that, we have with us Matt Dines. Matt, thanks for joining us once again.
It's a pleasure to be here. Thanks, Nik.
All right, Matt put together an excellent slide deck for us. Talk to us about Basel III. What is Basel III? Where does it come from? Maybe give us just a little bit of a background where these regulations came from.
So Basel III is the post-GFC set of reforms, if you will, that are kind of set up and agreed upon by the 63 member participant central banks of the BIS, the Bank for International Settlements. What they really are is kind of the same way, put this on a Bitcoin podcast, like the same way that Bitcoin is the consensus protocol. It's the base layer of how economic participants can come in and interact with the network, if you will. The BIS is kind of the same thing, and the Basel III Accords are kind of, you could think about it as the consensus protocol across the global mesh network of central banks.
The Bitcoin layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today. Yes, so the BIS in Switzerland is a bank of central banks, so its members are the individual central banks, and the BIS is putting together global banking regulations. That's the premise that we need to understand here, that these regulations are coming from a global banking standpoint. Okay, so talk to us about the specifics behind Basel III. What is the leverage ratio referring to, and how are, maybe you can also just say to start, how are assets regulated versus how are liabilities regulated from a banking sense?
So there's a lot of different pillars on Basel III that come in. You get issues there's a liquidity coverage ratio, LCR. There's a leverage ratio framework. There's a lot of different kind of moving pieces, if you will, that are really trying to come in and put a bumper lane on it's on the major banks involved in international kind of capital markets or money transfers. And some of these elements are of Basel III are kind of agreed upon stipulations that would identify how, for example, how much high quality liquid assets have, or stabilizing a bank's short-term funding plan, stuff like that. But the one we're talking about here today, the leverage ratio, and in each individual jurisdiction, like each sovereign state, they actually get to control the implementation so long as they meet the minimum standards that are kind of agreed upon at these kind of Basel conferences or negotiations between subcommittees of the broader BIS organization. But the leverage ratio really focuses on the right-hand side of your balance sheet, the capital side, if you will. It's focused on basically preventing the major money center financial institutions from over-levering, as we saw build up in really 2 to 3 decades, post 1970s, through the 80s, 90s, and then it all kind of popped in the 2000s with the GFC. But it was really the balance sheet leverage on kind of working its way, the growth in credit through the system that worked its way into the right-hand side of the balance sheets, where the ratios of total assets divided by the equity got really thin up until that point of the GFC, when that Lehman moment happened, and it snapped. And that's what this leverage ratio is really aimed at preventing. It monitors banks of a certain size involved in cross-border monetary transactions, just banking activity, from getting too far outside of that leverage pile, if you will. So there's a minimum requirement set forth in the leverage ratio. That's a standard that the BIS sets. We'll get into it, but then it's on each individual country to kind of implement in their own ways. That's kind of where we're at right now in the U.S.
And from a definition standpoint, we see this ratio is set at tier 1 capital as the numerator, and the denominator is total exposure. So specifically, tier 1 capital would refer to what type of construct on the right side of the balance sheet, and then total exposure is the entire L plus E, or the entire assets of the balance sheet. And could just walk us through the ratio, please, or which one, each numerator.
So we're going on slide 2 here. The BIS definition that every kind of member participant has to foot to and at least meet as their kind of like standard guidelines to be in compliance with Basel III would be, as you said, that tier 1 capital on the top. And that's really a measurement of kind of like your equity reserves that can kind of weather the going concern type of potential credit losses, if you will, on your total asset exposure on your balance sheet. So your tier 1 capital, we'll get into what actually encompasses that concept. And it's a summation of a couple of different sources. It's at the very bottom of the banking institution's balance sheet on the right-hand side. And then your total exposure is actually a non-risk weighted measure. So you've heard the terms risk-weighted assets, where, say, for example, a sovereign debt instrument is treated as like a 0% risk weighting to like all the way up to like 100% risk weighting on dollar for dollar, with an asset being counted in those type of measures, like say a normal corporate or industrial loan, something like that. This measurement does not get risk adjusted, if you will, or risk weighted, just based on different sliding scales or vectors that might apply to different kind of classes of credit that a bank is typically involved in and lending against. So
got it. So we have risk weighted assets as one of the type of banking regulation, but that's not what we're talking about here. This is an unrisk weighted asset in the denominator, and the numerator is this equity type capital at the bank. So let's go to this tier 1 capital slide. Is there anything that you want to add here on tier 1 capital being equal to common equity plus AT1?
So those two terms, you heard AT1 last year in the Credit Suisse episode. It was in the headlines. We'll get to that one as a case study. But the core thing here, this concept of tier 1 capital has been a part of the Basel Accords, if you will. Every Basel framework since Basel I in 1988 has had this concept of your going concern capital. It's been continuously honed and kind of adjusted by the regulators as the banking system kind of wants to push the limits of what this capital measure gets to count. But it's all like narrowing in on what is a financial institution's equity or going concern capital reserve has always been something that's been trying to pin down across all of these Basel frameworks. The other thing too, tier 1 capital, it's not mark to market. So in these calculations, these official regulatory measures, if you will, that each bank is kind of graded on by the Fed, the OCC, the FDIC, they are not mark to market. They're entirely balance sheet weighted. So that does play into, as we get into the case study of Credit Suisse, these aren't mark to market. So you really have a backward looking signal, if you will, on your capital reserve, which this kind of tells you what this metric is able to do from a regulatory standpoint. It doesn't tell you anything about the quality of the assets on the left-hand side of the balance sheet. What it really does is, or what it's designed to do, is prevent the banks from basically over leveraging themselves and not having enough kind of book value of equity to absorb potential losses. Um, so just final thing on this slide 3, the tier 1 capital is just the sum of your common equity. You'll see this in the regulatory filings. They call it set one. You see this other measure we won't talk about today, but the set one ratio, different thing. Another guest lecture series potentially. You get to include your retained earnings, your reserves, and then a bank also gets to include certain other financial instruments. These are typically bonds, but they have to meet specific parameters, if you will, or they have to have specific qualities attached to them to qualify as additional tier 1 capital under the Basel III framework. So the key ones here are that the dividends have to be discretionary. So these bonds will have a stated coupon, but it is not like a guaranteed liability or a guaranteed payment, if you will, or like a typical bond payment. It can be cut to zero. Same way when you see a bank actually or a financial institution get into a constraint, one of the first things you'll see them do is cut their dividend on their equity. That will free up the cash to address any leverage returns or say non-performing loan issues, stuff like that. So you'll see the dividend cut. The same thing on these AT1s. The dividends have to be discretionary so they can be cut, and also non-cumulative so that they don't accrue into the future as well. And then there's no specified maturity date. They're potentially callable on future dates by the bond, but they are by definition like a preferred share almost with an infinite horizon. Those are key because this bottom layer of equity, if you will, on the capital side of your balance sheet, it has to be non-runnable. Like it can't walk out the door. Like if you think about it from the standpoint of the top of your balance sheet where bank deposits sit, those can walk out the door and potentially worsen your problem as leverage takes hold. So the key measurements that Basel III kind of wanted to make sure they nailed down were actually like one of the big issues was like redefining what specifically gets to qualify as AT1 capital. So, yeah, go ahead, Nick.
And yeah, so thank you for that summary at the end, because this is for people that are looking for the basics behind what all of this means. This is the core concept here. A bank has assets. A bank has assets so that it can earn income on those assets. The assets come from somewhere. The money has to come from somewhere. That is the right side of your balance sheet, your liabilities plus your equity. So the point that Matt is making is that some of your liabilities are runnable in that they can be pulled easily, and some of them are not, like your equity holders and your long-term bond holders. So defining what specifically is the capital that cannot be easily taken out of the bank, and what can be is a big part of the job here, and that's what we're discussing. So that's what people need to understand here about the regulation behind the right side of the balance sheet. Now, if you could pause from this presentation for just a brief moment to explain risk-weighted assets. Now that we've discussed it, we're not talking about risk-weighted assets in this measurement of tier 1 capital, because that's a liability side. But how do risk-weighted assets come into the picture? Is it part of Basel III as well, just a different measurement? And just give us context before we continue on with the supplemental leverage ratio.
So your risk-weighted assets, as we kind of described earlier, you'll get, from the standpoint of the regulatory system, where credit risk is perceived, right? And your sovereign debt and agency debt, and then like mortgages in the middle, and then your corporate loans, personal loans, industrials would be at the top. The risk-weighted assets is really kind of a constraint on how the bank organizes the asset side of its balance sheet and can meet its, say, profitability targets. So most banks, the way they'll operate when they construct a loan, they look at their return on assets target, what they need, the numbers they need to hit, as well as they'll probably start from the bottoms up of like an ROE target, and then they'll build up from there. Those are kind of asset decisions on the balance sheet, and the risk weighting is really organized on just those metrics will be organized around making sure that the banks aren't loading up too much risk, let's say, or taking on too little liquidity. But each of those decisions, there's a very kind of wide degree of variability, like what types of lending a given bank or financial institution might involved in, how they weight themselves. But those risk measures are meant to keep kind of the ratios, if you will, on where the bank, where an individual bank is allocating itself, kind of just in line with good practice or general practices on how banks are stuffing the left hand of the balance sheets. And just for the context of how these businesses operate compared to any other sector in the economy, banks are much more heavily, and financial institutions are much more heavily levered than the rest of the economy. They're kind of a conduit from between capital and the ultimate credit creation involved in businesses, individuals, et cetera, in the system. So that intermediate layer, how that is sliced up and apportioned out. The FDIC, OCC, the Fed, they're concerned about that too, from like the health of the institutions. But in this specific case, we're talking about the SLR. It's really meant to ensure that the entire credit growth doesn't outpace the credit growth on an individual basis of a system, as well, an individual bank as well as the entire system. Let me rephrase that. Doesn't outpace the growth of the capital buffer layer as we kind of worked our way into up until that 2008 crisis. So this SLR is really, I would say, it's fighting the last war, making sure too much leverage doesn't build up into the system, getting ahead of or over the skis of your capital base.
Excellent. So I want to just go through a couple slides here. We have an AT1 bond example on the screen, and that is to show you that these are securities that are owned out in the market. So these types of securities have entered into Basel III's framework of Tier 1 capital. And in that way, these are bonds that are considered that where the capital itself is sticky and not moving around. In the next slide, we have a definition for the total exposure. In the denominator, BIS includes the on-balance sheet exposure, the derivatives exposure, repo as well as other balance sheet
Off balance
items.
sheet.
And this is, I'm sorry, off balance sheet, and these are not risk weighted. Then let's get into the next slide, which here is the U.S. implementation of the SLR. So in 2014, the Fed, OCC, and FDIC defined SLR as the implementation of Basel III's leverage framework, the formula that we've been talking about. So what can you tell us about 2% versus 3%, and what's specific in the U.S. with the SLR?
So the SLR is just the individual term that we've attached to our kind of candidate, if you will, to the central hub, the BIS. So when you hear SLR, that's the US's Basel III leverage ratio implementation. So the general guideline or the minimum guideline of 3% is for institutions or like industry wide. That's your minimum. So it applies across all banks. It's actually of a certain size. Like if it's a small, sub-regional U.S. bank, you probably aren't that concerned with this from a standpoint, but you still want to hit that minimum 3% target. The key thing where the rubber meets the road are the GSIBs, the large institutions. So I think there's 29 GSIBs globally. I double checked me on that. We lost one last year with Credit Suisse, but there's 8 in the United States. So those GSIBs are actually held to a higher surcharge, if you will, in addition to that 3%. And so and this extra kind of surcharge onto that minimum guidance is called the enhanced SLR, or you'll see it ESLR with a lowercase e. It's 2% tacked onto your 3, so it's a 5% minimum SLR ratio, if you will. And then it's actually, if you're the insured deposits arm of the bank holding company that's a GSIB, you actually get another point. So you're actually held to a 6% SLR for the deposit bearing. So an FDIC bearing institution. So the reason for that is obviously the government support, publicly financed federal deposit insurance fund needs to be protected, and so there is an extra kind of surcharge, an enhanced capital buffer, if you will, on top of the extra amount for being a GSIB to kind of ensure the integrity of those bank deposits, if you will.
Okay, and on the next slide here, we have a look of the GSIBs around the world. These are the S and the I in GSIB stand for systemically
Yeah.
important. So these are banks that are important to the system. And again, these classifications are done from a global banking standpoint because that's the world that we live in. It's not just what is the Fed regulating, it has nothing to do with how the system operates as a global. And the takeaway here from this slide is to show you that the US banks, the mega banks, are in a basically a higher echelon of SLR relative to Europe with a full 1 percentage point over that might be, because of this extra point here in the from the FDIC perspective. Maybe you can shed some light on the difference between US and
Yeah,
European banks.
so exactly the 5% is really it's a binding constraint, if you will. There's some others that could some other ratios that these banks have to maintain compliance with, but really effectively this SLR and ESLR are the binding constraints on capitalization for these institutions. So you'll hear from the Fed, the regulators, just Neil Kashkar. You can hear him, every quarter almost. It's like clockwork. He'll make a statement: the banks need to raise capital. We're undercapitalized. But if you're looking at the GSIB standpoint, holistically, ours look pretty good in general. I think you don't see anybody flirting with the low end, like of well into the fives or cutting it close. This was actually a Q2 poll of 2022, so you actually have to go into the regulatory filings to pull these. But the real balance or like capital side of the balance sheet weakness, if you were picking one, it looks like the European banks are closer to that 3% target, like collectively as a group, than the whole. I'm not super in depth with the EU banking. I don't cover those names. I don't know if they have that same extra surcharge on these individual names. I do know just from the balance sheet health, obviously, like this is coming through, it's materializing, and the rate spread differential between what the U.S. is able to support and its banking system versus EU. That kind of shows up in the sovereign rates as well. So apples to apples, like our GSIBs look a little bit healthier, if you will, from this ratios perspective than the EU. And the Asian banks, while there's more spread involved, Mizuho on the low end as far as this table was produced. You see a lot of names in the sixes and sevens, and you just have to get into the idiosyncrasies. Like China, like a lot of those, you're looking at the Chinese banking market, which kind of a more closed capital market system. It's just going to have its own idiosyncrasies versus the U.S. banks. But in practice,
And
that when you see 5%, they're generally close to that 5%, 6% framework, which is telling you this is the binding constraint. And what actually happens if you dip below it, it's not necessarily that you're fined or whatnot, but what it will limit your ability to do as a bank is issue dividends, share buybacks, or bonus pool for your staff. So in effect, just because of the P&L and your capital returns, it is treated as a real constraint by the banks in the system.
so the last question I have for you is about Credit Suisse, a systemically important bank that went under last year. I want to do a full episode with you on the G30 paper that we've been discussing, and the potential for pre-positioned collateral at central banks in times of crisis. So I don't want to go all the way there, but tell us about Credit Suisse failing in March 2023, and what did we learn about
Yep.
Tier 1 capital?
So Credit Suisse was a GSIB. So big story last year, one of the 30 GSIBs that are the core of the core foundation of the global banking system, if you will, ran out of Tier 1 capital last March. So you see this, remember we talked about common equity Tier 1. That's this chart on the left-hand side. Everybody kind of followed the drawdown that was happening in the Credit Suisse stock price. So it was very apparent, like from a market perspective, that there was something going on. There was a problem. So the common equity Tier 1 took 90, like a 90% drawdown over the course of roughly 2 to 3 years, which was effectively a loss, a wipeout from almost 35 billion in capital down to, at the time of the kind of the wind up, the closure, the absorption into UBS that came on, I believe it was Sunday, March 17th was the date. There was 3.4 billion on mark-to-market value on equity capital. So it was declining fast towards that zero absorbing state. And on the right-hand side, you see an article, if everybody recalls seeing this in the headlines, but part of the deal for the absorption into UBS was that some of the AT1 Credit Suisse bonds had to be wiped out. So everything kind of above the stack, essentially was absorbed in. There were a couple of haircuts, a lot of pieces went to different parties in the ultimate deal workout. But the nuts and bolts of what happened is the Tier 1 capital was just eaten through. Common equity decayed down to zero, and AT1 bonds were wiped out. There's not much left after that. Besides your retained earnings, your reserves, the furniture in the building, if you will. So that was really from the perspective of the metric what happened, but it doesn't alone tell you why, right? So something on the asset side had to have happened. The story isn't fully baked as to why. We know at this point why Silicon Valley Bank failed, the bridge loans involved in private equity, private credit, that no one would take as collateral. That's maybe a whole nother podcast. But for Credit Suisse, there was something going on with its leverage ratio measurements. It actually the leverage ratio actually starts increasing so that the bank looks healthy or healthier, like things were improving. From the case in point, as more kind of headlines and stories are kind of publicly revealed on what exactly was happening, the off-balance sheet items and the derivatives exposure likely played an important role in what was going on. There were probably, mark-to-market losses as Credit Suisse was on the wrong side or offsides on some of their swaps or derivatives exposures. And as those were closed out or rolled up or forced out, if you will, that in effect was decreasing the total exposure on the leverage ratio metric, which was making it kind of look elevated. Whereas if these results were mark to market, you would kind of see with almost obviously that there was a problem here, like in the equity chart and the bond pricing, et cetera. And the other thing we didn't really mention about the AT1 bonds, Nick, a lot of these issues just do not trade very often. Like QSIPs are different than equities. They're not necessarily fungible. One JP Morgan bond isn't the same thing as another. There's no kind of reciprocity between them if you're thinking about them from a trader's perspective. And one QSIP, like an AT1, might trade only a couple of times a day, or if it's a smaller financial institution that's still involved in international capital markets, you may not see a print on these bonds in a day. So you sometimes you can't mark them to market, and you don't know right away from the regulatory standpoint where the losses are. So case in point, Credit Suisse kind of shows you, despite all the efforts to fight the last war, um, these metrics can't by themselves like prevent uh, all all types of different ways things can go wrong from happening or taking place.
Understood. And then Matt, set up the next episode in which we'll talk about the repo news that we got that treasuries themselves won't be counted against the SLR in the same way. Can you describe that and set it up so that people can go read, maybe recommend something to read or a podcast episode to listen to so that we can all learn and set ourselves up for a full conversation on what's going to happen with Treasury
Yep. So
repo going
where the
forward?
battle lines are drawn right now, specifically with SLR, is kind of tying back to the non-risk weighting in the metrics. And as I said, this is a binding constraint. So when these GSIBs, especially the 8 US GSIBs, are involved in treasury dealing and market making, as we've seen with the fiscal policy situation, the rapid growth in treasuries, requires a commensurate amount of balance sheet capital applied to provide liquidity into that marketplace. So there is a big battle line right now going on as we're getting into what's called like the name for this they're throwing around is the Basel III endgame, as the kind of implementation is hitting its late stages or supposed to be. But there's obviously still a lot to work out as we're going to get into. But because this metric is non-risk weighted, you don't get any extra credit for holding treasuries and applying, the left-hand side of your balance sheet or your total exposure to buy and inventory treasuries if you're J.P. Morgan, Wells Fargo, Citi, et cetera. And that traditionally or typically is a low margin business relative to what, say, making a riskier loan would earn you. So, apples to apples, if you're trying to hit your ROE or return on assets target as a bank, there's an argument out there from a strong kind of stakeholder contingent or lobby that this leverage ratio constraint coming in from the Basel III Accords is actually prohibitive to dealers increasing their willingness to market make and provide liquidity into the treasury markets. Now, whether it's true or not, the actual effect, how it works out, that is an unknown. There is a unique stipulation in the Basel III Accords that allows for, in times of like exigent circumstances like COVID, for reserves held at your central bank to be excluded from your total exposure calculations, which was put in force from March 20 to March 2021. But treasuries are, by the Basel standards, like not exempt. Now, we actually made an exception. The Fed made an exception in March 2020 to allow for the exclusion of sovereign debt as well as reserves from the total exposure calculation, which not often raised, but it was a contradiction with the spirit of the framework. That exemption expired in March 2021. But this is kind of the battle lines right now on a push from a strong set of lobbyists arguing for the removal of treasuries from this kind of constraining metric. So that's where the argument is now, and that's kind of where the action is looking like it's going to kind of progress and take shape over the quarters and years ahead.
And the reason that matters is, as we've discussed time again, 10 trillion in cumulative deficits over the last 5 years and many more trillions to come. All of that deficit has to be financed, and that financing of that deficit is done through the treasury market. The treasuries themselves end up in the hands of the investment community all around the world, but on their way there, they have to travel through dealer banks. And if the dealer banks have to use their sticky equity and liabilities, the right side of their balance sheet, to finance and house treasury inventory, which, as Matt Dines is telling us, is a low margin business. And I can attest to that. Everybody's fighting for basically nothing just to be a service provider. If that service provider role is penalized by just so much more treasury supply, it makes the whole system potentially freeze up. And that's why we need a solution to that. We need something. I shouldn't say we. The banking system and the financial system needs to figure out how those treasuries are going to hit the market and get their way through to the end buyer. And that's really what we are going to continue to cover and understand. Matt Dines, thank you so much once again for helping us understand the banking sector specifically. Tell people what you're working on at Build and Unchained.
So we just closed out a strong Q1 today. And my focus, we talked about treasury markets. I'm heavily involved there in our fixed income funds. But specifically, what makes me unique, I think, is that I've leaned into the Bitcoin backed lending as a collateral basis in the direct lending landscape. So that's something I'm really excited about as we're going through this narrow issue, if you will. We talked about fighting the last war with what leverage ratio was supposed to address, like the buildup of leverage within an individual financial institution basis. But now we're actually fighting a new battle, if you will, and the risk has spread, in my opinion, to the sovereign debt issue, the sovereign market, debt market. So as we talked about how things are lining up, the focus now is on providing liquidity, smooth functioning of treasury markets, especially in time of distress. We can patch and take a technocratic approach and solve the last war all you want, but the real problem to be addressed is right in front of you. As we're talking now about all these kind of really quantitative and regulatory solutions, thinking that we can put these, if we can come up with the right parameters, we can just de-risk the system. I think that's a flawed approach, and ultimately, what Nik is addressing here is as the Bitcoin layer. My take, and I'm putting my money where my mouth is, if you will, or my capital allocations decisions, into that framework with Bitcoin as the reserve capital layer. So it's a plug for Nik's layered money approach. He was ahead of his time and continues to be among the leading and best advocates we have, like within not just Bitcoins, but the intersection with credit markets and fixed income. So really happy to come on and educate.
Appreciate you, Matt Dines. I'm Nik Bhatia. We'll
Thanks.
catch you guys next time. Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.